Hello everyone, welcome back. Today we are doing monetary policy theory. So we are going to look at the ADS model again, but now we're going to use autonomous monetary policy changes and see how can they be used to stabilize the economy. So we're going to work with the same model, the dynamic ADS model, but just have more fun with it with shifting of the AD curve. So remember, inflation targeting is one of the primary goals of our central bank, whether it be your US Federal Reserve or Bank of Canada in Canada. The understanding of the aggregate demand, aggregate supply model tells us that your central bank can target pretty much any level of inflation rate in the long run, and we can show that very easily through this diagram over here. So we are going to assume that initially we are at long run equilibrium, output is at potential at E1, and inflation is also at its target level, so everything is fine in the economy. However, we feel as policymakers that this target level of inflation is too high, so monetary policy makers want to permanently reduce inflation to a lower level, and let's assume that level is by 3. So how do monetary policy makers dampen the inflation rate, put downward pressure on inflation? We know they can do that by autonomous monetary policy tightening, that is increasing the real interest rate. That will lower consumption, lower investment, lower your net exports because of the Canadian dollar now becoming more expensive, and overall aggregate demand decreases to 82. This you can see has lowered our inflation rate from pi 1 to pi 2. So we are already halfway to our goal, but at the cost of reducing our output level also. So here we have a situation where the central bank has deliberately caused a recession in order to reduce inflation. And remember, this is simply the dilemma that we face between inflation and unemployment in the short run. In order to reduce inflation, in the short run, we'll have to bear the cost of higher unemployment. However, this unemployment is now not going to be a permanent feature of our economy because we know that the economy self-corrects itself. With a recessionary gap in place, slack in the economy, expectations of inflation are going to be driven down, which is going to cause your short-run AS to increase or shift vertically down. And as the short-run AS starts to adjust, in the long run, we are at E3, where output is back to potential. However, inflation is now even lower, and we have in fact reached our target level of inflation by 3. So the aggregate demand, aggregate supply model gives us a very strong policy implication that policymakers can target any level of inflation rate in the future, be it a higher level of inflation. In that case, they'll have to temporarily expand the economy, and the rest will be taken care of by the short-run aggregate supply curve. Or like in our case, reduce inflation in the short run to a lower level, and it will be permanently reduced to an even lower level in the long run because of the adjustment of expectations of inflation and the movement in our short run aggregate supply curve. Next, let's look at the use of monetary policy in response to business cycle shocks. And typically when you have a business cycle shock, your inflation is no longer at its target level and output is no longer at its potential. Potential level of GDP is typically the output goal that we want to keep, because that's the output level that is sustainable in this economy given its stock of resources like capital, labor, technology, and the underlying level of natural rate of unemployment. Any other output level, higher or lower than potential, is simply not sustainable because the economy will automatically converge towards its potential in the long run. So let's assume there's been an aggregate demand shock. Policymakers can respond to this shock in two possible ways, and the first one is not do anything. And when they're not doing anything, it's just saying that they are non-activist policymakers. These guys are the ones who believe wages and prices are fully flexible. So even if there is a shock in the economy, wages will adjust very quickly and rapidly to that shock, and expectations of inflation will be adjusted extremely quickly, and therefore output will always remain its potential. And if there's any change in the economy, that will only be on the inflation rate. So the AD shock in this case also doesn't really affect our output level. Output will go back to its potential rather quickly, and we'll only end up with either higher inflation or lower inflation depending upon the type of shock we are working with. Now the other side of the debate is that we actually should be doing something about it, and that's your activist monetary policy makers. Activists believe that wages are very sticky and inflationary expectations take time to adjust, so they do not respond very quickly to any changes in the business cycle. Hence, these group of economists and policymakers are the proponents of active monetary policy intervention in the economy in order to close the inflation gap or the output gap. So let's see how monetary policy can be used in the face of a negative demand shock. So initially we are at equilibrium, output is at its potential level, inflation is at its target level of pi 1t, and we are at point E1 on this diagram. The negative demand shock is causing our AD to decrease to AD2. This you can see will cause our inflation to fall below the target level and also GDP to fall below potential. So what can monetary policy do to restore inflation back to its target level and GDP back to its potential level? So note, whenever we want to stimulate economy and increase real GDP, we must be stimulating aggregate demand. And in order to increase inflation level in the economy, we again must be increasing or stimulating aggregate demand. So both of these goals can be achieved by stimulating AD through autonomous monetary policy easing. And that is real interest rate by Bank of Canada or your central bank must be reduced. So as the central bank conducts expansionary monetary policy, aggregate demand curve will increase and shift to the right. And as it increases, you can see we are putting again upward pressure on inflation. Inflation goes back to its target and output increases back to its potential level. This coincidence of achieving both your output goal and your inflation target is called the divine coincidence. And we see this primarily happens only in the face of demand shocks. For any other type of shocks, we typically do not see this happening. And this will be clear when we look at our next shock, which is our permanent supply shock. In a permanent supply shock, remember, your potential itself changes. It is no longer at the same level. It could be higher or lower, depending upon what type of productivity shock we are seeing. So how will policymakers respond to that? Again, one option is don't do anything. So you are the non-activist monetary policy maker now, and you say let just the economy be, and the economy will automatically self-correct itself and move towards its new potential level. However, if you're concerned with the level of inflation that now we are working with because of this shock in the economy, you can now be in the activist camp and propose some changes in the monetary policy that will restore the inflation rate to its target level. So let's see how that occurs. So we have again initial equilibrium at point 1 where output is at potential and inflation is at its target level. Now, if we have a permanent supply shock, remember it shifts both your short-run AS and your long-run AS curve. So both are going to change. And we're assuming it to be a negative shock, so potential is a lot lower than before, and the short-run AS is also shifting, showing us this decline in productivity in the short run. As the short-run AS decreases, our new equilibrium is at point 2, which is showing us that inflation has increased in the short run and output has decreased compared to its initial level. So how do we restore the inflation target in the face of this permanent productivity shock? So monetary policy makers, when they want to dampen inflation rate, they will always use autonomous monetary policy tightening. So that will dampen aggregate demand curve to AD2, and this contraction in AD you can see reduces output further to Y3, which is our new potential, and puts downward pressure on inflation so it reaches its target level of pi 1t. Next, let's look at a temporary supply shock and how will monetary policy respond to that. Now, whenever we are looking at policy responses, the first option is always no policy response, don't do anything, and in this case the negative temporary supply shock will simply correct itself. Both inflation and GDP will go back to their initial levels. However, if we don't want for self-correction to occur and we want to actively intervene, in that case policymakers face a trade-off. Policymakers will not be able to restore inflation target and output target at the same time. They now have to choose between these two goals. They can either restore inflation level, so pursue price stability in the economy, or restore the output level to its potential. So let's look at our temporary supply shock, and we'll assume it to be a negative shock for now and see how will monetary policy respond to this in the event that they have a hierarchical goal of inflation stability. So we are initially at equilibrium point 1. The negative supply shocks lands us to point 2, and here you can see inflation has increased above its target and GDP is below its potential. This situation is what we call stagflation in the economy. Higher inflation level accompanied by stagnation or recession in the economy. If our hierarchical goal is inflation stability to bring inflation down to its target level, we know we have to dampen AD, and this can be done through autonomous monetary policy tightening, and this shifts the AD curve to the left and we are at equilibrium point 3. However, note at 3 we are dealing with a much bigger recessionary gap. Output gap has worsened. GDP has moved from Y2 to Y3. In order to restore price stability, we have to bear the cost of even bigger recessionary output gap. Now let's assume it's the same negative supply shock, a temporary one, so only shifting your short-run AS. However, now we have a central bank which is pursuing output stability. So their primary goal is to bring output back to its potential level. The negative supply shock has again caused inflation to rise above the target and GDP to fall below its potential. In order to bring output back to its potential, we must be stimulating aggregate demand. And as we stimulate aggregate demand, our equilibrium is now at 0.3, which is bringing output back to potential. However, the cost is even higher inflation. So you can see in the face of temporary supply shock, we cannot achieve both output targets and inflation targets at the same time. Temporary supply shocks, when they are positive, give us a huge opportunity to reduce inflation in the economy permanently. So let's assume we are at equilibrium point 1 and there is a positive supply shock. It's causing inflation in the economy to go down to pi2 and GDP is now a lot higher. Instead of waiting for self-correction to happen and short-run AS moving back to its original position, monetary policymakers can quickly intervene in this economy and dampen AD. If they dampen AD, we will be now working with a lower aggregate demand curve through autonomous monetary policy tightening. With this autonomous monetary policy tightening, we have brought output back to its potential. However, note we have now permanently reduced inflation in our economy. Inflation has been reduced to pi3. So positive temporary supply shocks give our policymakers an opportunity to reduce inflation permanently without having to cause any recession in our economy. So now that we have seen our three main types of business cycle shocks, demand shocks and supply shocks, we can conclude that in the face of aggregate demand shocks and a permanent aggregate supply shock, policymakers can stabilize both the inflation level and economic activity with the same policy in the short run. A negative temporary supply shock shocks are a dilemma for policymakers because they cannot stabilize economic activity and inflation at the same time, so they have to choose between one of these goals. However, a temporary positive supply shock is a hidden blessing for policymakers because this gives them an opportunity to reduce the inflation rate in the economy permanently, as we just saw in our previous diagram. Next, let's look at some situation in which our monetary policy ends up creating inflationary spirals in our economy. Typically, these inflationary spirals happen when our monetary policymakers have high employment or high output targets. The actual cause can be supply side, and we can call it then cost push inflation, or it can be a demand side shock that is initiating this inflationary spiral, and in that case we'll refer it to as a demand pull inflation. In a cost push inflation, we will have typically an economy which is facing consecutive supply shocks or inflation shocks in the economy, but accompanied by a central bank that is pursuing high employment goals. In the face of demand pull inflation, we have policymakers which are continuously pursuing high employment or high output goals which are higher than our actual potential GDP. So here the inflationary pull will be coming from the aggregate demand curve. Let's look at our cost push inflation first in terms of the ADS model to see how it actually plays out. So initially we are at 0.1, economy is at its long run potential, and inflation is also at its target level pi1t. If we have a negative supply shock now, this will cause our AS curve to shift to the left and causes inflationary pressure in the economy. Inflation is higher than the target and causes a recession in the economy. Now this is a temporary supply shock, so nothing has happened to our long run AS curve. With a central bank which is committed to a high employment goal, it will immediately interfere in this economy and stimulate aggregate demand through autonomous monetary policy easing. And this monetary policy easing brings us back to the output level YP, however at the cost of very high inflation at pi2. Now if the supply shock, as I said, is a persistent supply shock, it keeps on happening, it again decreases our AS to AS3, and again we have an even higher level of inflation somewhere over here, and GDP goes back to our lower production level of Y2. And again a central bank committed to high employment, it stimulates aggregate demand through autonomous monetary policy easing, and we are back to our potential but at the cost of very high inflation at pi3. We have had now 2 consecutive supply shocks. If this continues with another third one, we have an even higher inflation level. Policymakers committed to high employment goal will again bring us to 0.3. 0.4, which is output at potential, but inflation you can see is spiraling out of control and all the way up to pi 4. This situation over here is not completely hypothetical. We have seen our economy going through such inflationary spirals in the past. We saw something like this happening in the 1970s. We had these consecutive oil price shocks which were causing this inflationary pressure in the economy, but a central bank committed to high employment was making the situation worse and really aggressively pushed this inflationary spiral upwards. When will this spiral stop? This inflationary spiral will only stop when at some point your central bank stops pursuing this high employment goal. So let's assume we are at 0.4 and there is another negative supply shock and we land at 4 prime. At 4 prime, if the central bank now realizes that they will have to let it wait out and they should not be pursuing this high employment goal, eventually the self-correcting mechanism will kick in. So at 0.4 prime, this recessionary output gap is eventually going to cause inflationary expectations to go down and our short-run AS is going to shift back to AS4. And as it shifts back, we move from 4 prime back to equilibrium 0.4. So the only way to short circuit this inflationary spiral is a central bank which lets go of this high employment target. As long as they are pursuing this high employment target, it is making your inflationary spiral more and more aggressive. The second type of inflationary spiral comes from the demand side, and this is when your central bank is pursuing a high employment goal. Now this could be because of data errors where they are pursuing output target level which is higher than potential, or it could be because of politicized central bank which is pursuing high output goals at the pressure of the government, or in some cases it could be because of monetizing of the debt when you're pursuing persistent budget deficits by printing money. In all of these situations, we can assume we are initially at 0.1 where output is at potential, and now the aggregate demand curve is stimulated through autonomous monetary policy easing, and this stimulates our AD to AD2. Note output is higher than potential and inflation is higher than its target level. But this high employment or high output goal is not sustainable. This is in fact an inflationary output gap, and with inflationary output gap, expectations of inflation are revised upwards and cause our short-run AS to actually decrease. And as the short-run AS decreases, we move to our 0.2 over here. At equilibrium 0.2, we are back at potential GDP, but at the cost of even higher inflation. A central bank committed to a higher employment target of Y2 will again stimulate AD, cause inflation to go up. Inflationary spiral will again transpire out because of the positive output gap, causing AS to again decrease or shift upwards, reflecting these higher expectations of inflation. And you can see inflation rises to pi 3. Again, you can see we have an inflationary spiral which is constructed by the central bank itself. This inflationary spiral will only come to an end again as soon as the central bank stop pursuing this high employment goal, which is over and above its own potential level. As long as they're pursuing this output goal of Y2, which is higher than the potential, this will keep on continuing this inflationary spiral upwards. As soon as they let go of this high employment goal, we see that this inflationary spiral will come to a stop and we will be at our long run equilibrium again. The sooner we realize our mistake, the better it is for the economy, because in that case, again, you can see we could have prevented this inflationary spiral from getting out of control in the first place. So far we have been looking at conventional monetary policy and some of its problems. Now we will look at monetary policy at the zero lower bound. Conventional monetary policy, remember, is when your central bank raises the real interest rate as inflation rises and it lowers the real interest rate as inflation falls. And these were automatic responses in monetary policy. This basic understanding of the automatic response of monetary policy gives us the shape of the aggregate demand curve. So for example, when inflation was rising, we increased our nominal interest rates by more than the inflation rate to ensure real interest rates are going up and causing our aggregate output demanded to decrease. Or if inflation is falling, we are going to reduce our nominal interest rates by more than the decrease in inflation to ensure real interest rates fall, so that aggregate output demanded will increase, and that gives you this negative relationship between the two. So this negative relationship is giving you your downward sloping aggregate demand curve. However, note that when we are working with inflation which is going down and we are trying to reduce our real interest rates, there is a limit to this policy, because eventually nominal interest rates will approach zero and we will not be able to push them any further. When we reach this situation, we call it the zero lower bound. At the zero lower bound, interest rates cannot be pushed any further. So we are stuck with our real interest rates actually rising with lowering of inflation. So we can see that through the Fisher equation. As inflation falls now and you're at the zero lower bound, so nominal interest rate cannot change. This is causing your real interest rate to actually go up. With real interest rates rising, this is actually going to cause your aggregate output demanded to decrease. So as inflation is falling, aggregate output demanded is also falling. So what's happening to the shape of your aggregate demand curve? It's actually becoming an upward sloping curve. And this gives us our kinked shape AD curve. At low levels of inflation, especially when we have reached the zero lower bound, we can no longer change our nominal interest rates, at least not push them down any further. And this gives rise to this upward sloping AD curve. Let's look at the textbook diagram explaining the same. Here they're assuming the zero lower bound occurs at inflation rate of 2%. So as long as inflation rate is higher than 2%, we are working with a typical downward sloping aggregate demand curve, telling us that as inflation falls, nominal interest rates will fall by more than that in order to ensure real interest rates fall. Whereas at 2% or any inflation rate lower than 2%, we have reached the zero lower bound, so we can no longer reduce our nominal interest rates. And with the inability to reduce our nominal interest rates, the AD curve is becoming upward sloping. This kinked aggregate demand curve becomes very problematic, especially in the face of a huge recession where your intersection of the AD and short-run AS is happening in the upward sloping section. In the upward sloping section, the self-correcting mechanism is no longer operational. So now when your short-run AS adjusts with the expectations of inflation, it will actually not make your output gap smaller, but it will make your output gap bigger and will end up creating a deflationary spiral in our economy. So in this diagram, we are now in a recessionary output gap with our equilibrium at 0.1. Note that this equilibrium point is in the upward sloping segment of AD. So we've already reached the zero lower bound. Nominal interest rates or conventional monetary policy can no longer be used to stimulate the economy. Now, if we cannot lower interest rates any further, in the face of a recessionary output gap, we know expectations of inflation are driven down, and with the expectations of inflation driven down, short-run AS increases. As the short-run AS increases or shifts vertically down to reflect this lower expected level of inflation, you can see it is making our output gap actually bigger than before. Our inflation has gone down to pi 2, which is a lot lower than our initial level. Again, in the face of this recessionary output gap, this process is going to continue. Expectations of inflation are going to be driven down and our short-run AS is going to increase. But as this happens, you can see our output gap is becoming bigger and inflation is going further down. So you can see in the absence of our self-correcting mechanism, we are seeing a deflationary spiral in our economy. Conventional monetary policy can no longer be used. So what can we do as monetary policy makers to get out of this deflationary and recessionary spiral? This is what brings us to our non-conventional monetary policy tools. We have discussed them in our previous chapter, and now we'll look at them in the context of the zero lower bound and how can they be used to stimulate both output and inflation in our economy. Now remember, some of the non-conventional monetary policies were your liquidity provisions. So this is when Bank of Canada extended its lending facilities to provide more liquidity to banks to reduce financial frictions in the economy. This will stimulate our investment and therefore aggregate demand in the economy. Another type of non-conventional monetary policy was your large-scale asset purchases in the form of quantitative easing or credit easing. In the case of quantitative easing, we're providing excess reserves through the purchase of long-term government bonds. And in the case of credit easing, the central bank is increasing its assets by purchasing corporate bonds and providing liquidity to particular segments of our markets. Both through liquidity provision and asset purchases, the central bank is lowering long-term interest rates, which will help reduce the real interest rates in our economy and thereby provide the much-needed stimulus to investment, aggregate demand, and overall economic activity. And in the third case, we have forward guidance or management of expectations. Remember, here we have a central bank which is committing to keeping short-term interest rates at very low levels in order to ensure that expectations of inflation are driven up. So all of these non-conventional monetary policy tools will now be used in order to short-circuit this deflationary and recessionary spiral. Let's look at a situation over here where we are at short-run equilibrium 1. You can see we're in the upward segment of AD. So if we don't do anything, the economy will go into a deflationary spiral, and we don't want to do that. Bank of Canada or your central bank can stimulate aggregate demand through through liquidity provisions, reducing financial frictions in our economy, stimulating investment in AD. This will stimulate our aggregate demand, and the entire curve will shift to the right. And you can see in this case we have closed the output gap and also increased our inflation to pi 2. Similar diagram can also be used for large scale asset purchases or quantitative easing. So quantitative easing is again providing liquidity to your financial markets, reducing your long-term interest rates, which are stimulating investment and consumption and causing our AD to shift to the right. In this diagram, remember, I am assuming that these non-conventional monetary policy tools are very effective and are successfully closing both our inflation gaps and our output gap. If we were to use forward guidance, now you're managing expectations of inflation in the economy. This will be primarily reflected through your short-run aggregate supply curve. So assuming again we are in a recessionary output gap, which is on the upward sloping segment of AD. If the central bank is committed to keeping interest rates low for a very long time, and that successfully increases our expectations of inflation, this is going to stimulate our aggregate supply curve. Short-run AS curve is going to shift up or decrease to reflect this higher expectation of inflation. As this short-run AS curve shifts up or to the left, you can see that the output gap is eliminated. And here we have closed the output gap from Y1 to Y2, which is again equal to our potential. And we've also increased our inflation rate from pi 1 to pi 2. The biggest achievement of non-conventional monetary policy tools in these diagrams is to somehow bring our equilibrium in this downward sloping segment of AD. Once we are back in the downward sloping segment of AD, anywhere over here, we can again start using conventional monetary policy. The problem, remember, is that when we are in the upward sloping segment of AD, we can no longer use our conventional monetary policy, nor can we rely on our self-correcting mechanism. We saw the problem of the zero lower bound happening in Japan for almost a decade. This is referred to as the lost decade of Japan, in which they saw continuous decline in their production along with deflation in their economy. And because they were stuck with very, very low interest rates, in fact negative interest rates at some points in time, they could no longer use conventional monetary policy. Come 2013, a new prime minister with a completely new central bank team, we see non-conventional monetary policy being used in the form of large-scale quantitative easing programs and a central bank committed to increasing inflation to 2% within a very short period of time. If the central bank is very credible, that will increase expectations of inflation eventually and cause your short-run AS to shift up. Along with your quantitative easing programs, both the AD and your AS are shifting, and we see that the output gap has been eliminated. This new policy strategy helped Japan come out of its 15-year-long deflationary spiral. It helped increase the inflation rate above zero and also led to lower unemployment levels. However, they still have to see the inflation target of 2% being met. This shows us how difficult it is to raise inflationary expectations, especially after a very prolonged period of deflation in the economy. So that brings us to the end of our chapter. In this chapter, we looked at the role of monetary policy in the context of the ADAS diagram, how we can use monetary policy to close different type of output gaps or inflation gaps, how untethered monetary policy can cause inflationary spirals, and lastly, in the face of the zero lower bound problem, how non-conventional monetary policies can be used to stimulate the economy out of its recessionary and deflationary spiral.